So there's been a lot of speculation from commentators around the world on the impact of what our current situation will have, so that with the global lockdowns. I'd like to begin by getting your view on the prospects for some of the major economies and what maybe some of the impact that the COVID-19 and the lockdown will have.
It's a big topic, and each country is doing it in a different way. And even with the United States, each state's doing it in a different way, and that's leading to lots of conjecture and debate. So to start off with, let me counsel that I can't be sure what's going to happen in all these different places. But I do think in time there's going to be a major restructured change in the way people exist, the way governments behave. There's going to be a lot of accusations about this and whatever. It's clear to me that Singapore, China, Taiwan, Japan, and Germany in particular, and Europe have handled the situation very well, whereas Italy, Spain, UK, and US are handling it very badly, and that'll have implications for their governments. The difference in Germany and Singapore and China is that they've been identifying people earlier and isolating them earlier, plus they've been scaling up the hospitals and dealing with the problem at the hospital faster. And yeah, it's been a management issue, and some countries have done it well and others haven't, and it's led to a much higher death rate. So let's just go back to the fact that this is just a flu, although it's a bad flu and a lot of people die from other things. And even if this gets to 100,000 deaths, it's much less than the flu, which kills about 1.25 million people a year, and car accidents that kill 1.25 million people a year. So the real issue here is the panic which has been instilled by people's reaction. And I understand the humanitarian side, and certain governments have gone for the pragmatic side and have been overruled by the humanitarian side, leading to flip-flop strategies that you're seeing in the UK and the US. This is all very damaging at lots of different levels. So the shutdown, how does the shutdown affect different economies? Well, it depends how much social backup they've got. You've got these policies that are coming out and money's being floated down. They call it a stimulus package. I think it's a sustainment package. If a guy getting $1,200 in the States is not going to go out and buy a car or whatever. It's going to spend it on food. But the disruption to different segments of the economy is massive. And as it affects us, let's look at valuations. If companies are trading on a 20 to 25 PE and it loses 6 months earnings, should the stock trade down much more than half a PE or 1 or 2 PEs? The answer is obviously no. But if the stock loses 6 months of turnover and it's on a 5% margin, then it's lost 10 years of earnings in 6 months. Then it should be half. And the world stock market's only fallen 30%. So lots of disruption, lots of different futures to come. But I would highlight that there's a bigger disruption going on than the virus, and that's the oil price. Oil price is down at $20 and $25 for Brent. That has a big impact on a lot of people and a positive impact on South Africa and Japan and China and India. Very negative for geopolitics in the Gulf. And it has an impact into dollar. And there's a dollar shortage. And the oil price down here is going to exacerbate the dollar shortage. So whereas the dollar should perhaps be rolling over here, particularly with interest rates in the States coming down to European levels, and the carry there not so much, there's a dollar shortage. So you're seeing that the dollar hold up when in fact it should be in its 9th innings of its bull market. So lots going on here, Rob.
And what's your view of the action or the stimulus packages that have been put in place or touted by a lot of the governments around the world?
Well, again, each country is doing it in a different way, but I don't think they're stimulus packages. They're trying to stop people starving or losing their jobs or allowing them to meet their mortgage payments and different things. And how they're going to work, I don't know. Um, as I say, I don't think people are going to be buying cars and things like that with it. So good for the food industry, but the cyclical industries are still going to suffer in this shutdown period.
Do you think this will have a knock-on impact on inflation in the future? I mean, a lot of commentators have been touting that we'll return to growth in Q3. Do you think that's feasible?
Well, well, who's going to pay for all this? And the answer is you and me, or the taxpayer. Um, so that's a negative for the economy in the longer run. But break it down into three sections. In the short term, you get deflation, lower oil price, lower activity, and then in the medium term, you get some shortages cropping up, and that's a part of the shutdown issues. What's going to happen to delivery of certain items, including food, if this lasts more than it's all been set up to last for 4 weeks or 6 weeks, but if it lasts 3 or 4 months, as it's lasted in China, then you start to get problems on delivery of food and things like that. And then in the medium term, that becomes a little bit inflationary. But I've been surprised that we haven't had inflation in the world because of all this QE, etc., and how they fund these purchases. $2 trillion is not small change. Got to be some inflationary impact further down the track. But is that offset by oil? Oil is a major input into inflation numbers. So definitely deflation in the short term. Probably a tick up in inflation on shortages further down the track, but that's just a bump. But will the inflation genie be out of the bottle in year 4 or 5? There's an increasing risk of that to me. I can't be sure at this stage.
And this central bank action has also been quite swift and strong. Have they used all their bullets? Is there anything more they can do? Is there anything more they will do?
Yeah, interest rates is just the price of money, and it's down to nothing, and it's really ruining the world and capitalism. So it's just another leg down in that thing. But yes, they can do quite a lot more, providing liquidity in the market, pulling levers to make banks lend. There's a lot more that they can do other than just the price of money. It's the availability of money. And we saw in the last crisis, it took a while for the availability of money to come through, and America did well and Europe did it badly, and because Europe did it badly, they've suffered 10 years of very slow economic growth. But this time I think they'll have more practice at it, so there's a lot more that the banks can do, central banks.
Do you think we might see more central bank action here in South Africa?
It looks like it's heading that way from the comments we've seen from both the finance minister and the governor of the Reserve Bank over the weekend. They're releasing the banks, they're allowing the banks to have more flexibility in the way they manage their balance sheet in order to encourage them, and there'll be lots of moral suasion on the banks to help the economy and those in the economy who need it.
So that's something else that happened recently, or on Friday, was the downgrade from Moody's. We're seeing some reaction in the bond yields and currency today. I mean, was this not largely expected, and are these movements today quite surprising? What's your view there?
Well, it should have happened about 18 months ago, and it's taken a long time for it to happen. It's really unfortunate that it's happening now, and of course, it's never a good time for it to happen. But the timing of it is right in the face of a blowout in the corporate bond market in the States, where the yields are up over 10%. So junk in the States, high yield in the States is over 10%. And SA is in that high yield bucket. So our bonds were going up the week before because of what was happening in credit in the States. Now you've got this extra sale now into a market where there's a buyer's strike. There's lots of sellers on the ETFs and things like that in the credit markets. So there's hardly any buyers in junk debt, and now you're getting forced sellers from those in the index. It's no wonder that our bonds are blown out a little bit further. But there have been a lot of people waiting on the sidelines expecting this to be the buying opportunity. So I would expect some buyers to come in at this price, at these prices. I think the bonds are offering great value now.
And you touched on the US high yield market, and it's somewhat driven by the extent of energy related companies that have issued in that market. And we saw, I think it was 2016, we saw the high yield spreads blow out, but it was very quickly came back in again. Do you think that that might happen this time as well, or it's very different?
It's a similar situation, but it'll last longer this time because Saudis are keeping the oil price lower. There's too much oil being pumped. Shutdown is going to create a lack of demand in both motor vehicle and airline consumption of oil. So it's going to last longer. The Saudis need to keep the price down for longer to take out the shale companies who've got about 6 to 7 months of forward cover. It's yeah, those oil companies, but it's not just the oil companies and because the interest rates have been so low. A lot of companies have been borrowing far more than they should, and they've been allowed to borrow more than they should because the credit markets have encouraged them to do so. And now it's now it's white knuckle time, and the dark cloud you see is the chickens coming home to roost in the credit markets.
I'm going to change tact a bit here and just talk a bit about some of the equity markets around the world. And China, Hong Kong, and some other Asian markets have actually weathered the downturn better than the Western developed markets. Do you have any thoughts on why that might be?
Well, they weren't as expensive, and we're getting a little bit further into handling the COVID issue. Um, we're quite pleased with ourselves because the China stocks we got, Hong Kong is outperformed by about 8% year to date, and the big stocks we got at 10 cent, CCB and ICBC, they've outperformed Hong Kong by about 8%. So we're getting some really good alpha out of those stocks. But there's better growth and more, and the valuations were not as stretched in that market. That's why they've held up so far. But there's big correlation going on. Quants are trading all over the place looking for hedges. And that's why you see the gyrations in the Australian market because it's open when US is closed. And it's a thin market, so you get Australia down 8%, up 9%. And that sort of correlation trades are also happening in the Asian markets. So lots of volatility created by these computer-driven strategies.
Does that create your opportunity for active managers?
It does. We try not to be that active, but we're not trading. But yes, I'm loving this all around the world. I love bear markets. Great opportunity to buy, especially when you've got cash, which we have lots of.
Yes, you've been defensively positioned for some time. So you touched on valuations. I'm guessing that largely led to this stance. But has the recent market moves instigated some internal discussions on changing this position, or, as you said, putting some capital to work?
Rob, I think the best way to answer that is just take you through how the fund is positioned.
Great, please.
Year to date, the fund is down 5%. Sorry, the March is down 5%, but year to date it's down 4%. With the moves we're getting today in bonds, we probably lost 2% in the bonds today and gained about 1% on the rand. Overall, the fund is 50% rand protected and about 50% in interest sensitive stocks, mainly bonds. And a lot of the bonds are the 186 in SA. So what's happened over the last 3 months is that we've lost from overseas investments in equities, and that's been more than compensated for by the fall in the rand. But we've lost a lot in bonds. We've lost about 6% The 186s, we bought at 9%, we're 8%, and a small change at the beginning of the year, and they now 11%. So we've lost a lot there. But I would remind people that we bought it at 9. Inflation's at 4, so we're getting, if we hold it to maturity, we're going to be getting 5% real, which is our mandate. And if we keep them from here, it's only 6.5 years before they mature, we'll get 11% from here, so we'll get our money back. So it's not a permanent loss. Unlike Sasol, which we had 1.5% in, that's probably a permanent loss. And then we've got a position in Anheuser-Busch, which I bought a little bit early. That's come down, and I'm sure that will go back. So when you're doing these, a lot of valuations are on mark to market, and they're not permanent losses because things will evolve in time, especially the way bonds work. But our equity position in the fund is 37%, 10% SA and 27% global. We've got a hedge on the global. I've increased it on Friday and today by selling S&P futures. So our global position is actually 21%. So we're about 31% in equities. And this fund, as you know, is only permitted to own 40% in equities. So we're 20% of full position underweight. And we've got the cash to buy up to that full position. And we're looking forward to be able to do that at the right time. But that's going to be the hard part, getting that right. We're very low in the fund in property. We've only got 4% in property, less than 1% SA, and 3 and a bit % global. Gives us some of the yield issue, but we've avoided the problems in the property market in SA, which is standing us in good stead. And our bond position is 40% SA and 5% global. And as I say, we're not in the long end of the curve. We're in the 6.5 year area mostly. There may be an opportunity to go a bit longer and lock in 13%. I don't feel that the 11 to see the extra 2% warrants it, because further down the road we may get some inflation in SA. So I'm not looking to extend the duration too much in the bonds, even though 13% looks juicy, 11% is just as juicy. I'd need about 350 basis points extra for me to go much further out on the curve. Gold we've got because of the move in the rand, and we do have gold in the overseas portfolios as well. We've got 7% in gold. I noticed that the forwards on gold are 1% premium in April and another 1% premium to May. So there's likely to be a little bit more upward in gold, but I'm tempted to switch some of that gold into cash and even buy some more bonds with that. And cash overseas and cash local comes to 8%. So if we add up the direct cash, the gold, which is near cash, and the hedge, we've got 20% available to invest. And it's that 20%, if we invest that at the lows, the distressed lows, because what's happening here, Rob, is that there's a panic on, and there's a liquidity need. So people are selling not on valuation, they're selling on the need for liquidity because they geared and they overgeared, and the banks are pulling them in, and their margin calls, etc. And people aren't able to value properly, but they're not. Most of the people selling aren't doing it on valuation. So that's where we can step in and pick up. But I don't think the panic's over. But we have been buying. We bought nicely last Monday, a few things, and generally. But it's work in progress, and times are tough.
Dave, you mentioned that gold has gone up to 7%. Did you add to that, or is that just on price appreciation since the end of the year?
It's price appreciation and relative change in the structure. Happened by price movement more than us buying.
And again,
we're likely to trim that back over the next 2 months. We use that cash to buy bargains.
And um, having seen the performance of the Foord International Trust as well, which is a large position in the fund, you've also been defensively positioned there. And have you made any changes in that to take advantage of what's been going on? Because I know that
Well,
you don't.
that's where
Yeah.
the equity hedges and the hedges on the S&P. And we reduced that a little bit last Monday, but increased it again Friday and this morning. But yeah, that Foord International Trust is pretty well positioned. We've bought quite a bit of equities. We may have bought those equities a little bit too early, but with the hedge, we're about 40 to 45% in equities in the Foord International Trust.
Okay, and just quickly touching on the energy sector around the world, we briefly talked about that high yield, but you have a very low weight in energy stocks in your global portfolios. Have the marked movements on the sector provided any interest there?
No, I don't think that oil's the future. I think there's a few things. We have a utility which is building up a lot of green energy, renewable energy, and that's more our pick there. Because we were low in oil, we had a small position in a very high beta stock, and then, as it often happens in those situations, that's turned out to be a disaster, and it's down 90%. Um, which we hadn't done, but it was a pretty small position to cover the fact that we didn't have the oils. But we're negative on oil, so that begs the question, why are we in Sasol? And the answer is, well, we thought the oil price wouldn't fall as much as the rand would fall, and Sasol is very sensitive to the rand, more sensitive to the rand than to the oil price. And we also like the gearing in Sasol and buying a new company in Lake Charles, etc. But between the bad timing and debt and companies with debt being hammered, and now the lower oil price, Sasol's had a quadruple whammy of bad events. So yeah, we wish we'd stuck to our view of not liking oil and not having Sasol, but we got that wrong, unfortunately.
And Dave, you touched briefly on AB InBev, and you said perhaps too early there, but I'm guessing that was just a factor of what happened in the market rather than the prospects for the business.
No, we think it's a great company. It's run by a family, so the family have organized the debt, so there's no debt covenants. There's no debt due within the next 4 years. So it's been pilloried like the rest of the companies that have high debt, but there's no risk of default. There's no risk of covenants being breached. And yes, there'll be disruptions to the amount of beer they sell and things like that. It'll take them a bit longer to repay that debt. But no, we love the business, and we love the idea that it's borrowed the cheap money that's around, and they use that cheap money to expand the business, and the shareholders and the equity holders will get the benefit of that in due course.
Okay, thank you. And then I always like to surprise you with a question we haven't talked about before the call, and so another big equity holding in the SA market is Capital and Counties. Can you give us your current view on that business for the future?
Great management. They did very well to get rid of Earl's Court, and they're concentrating on the area now of Covent Garden. It's a much smaller company now, and the balance sheet is strong, and they're in a good position to take advantage of the cheap properties in the UK. And being a rand hedge, an opportunity in property stock that we used more about. We were happy to hold it as a rand hedge, and importantly, the management of excelled at managing through the difficult property market that's existed in the UK over the last 3 years.
Thank you. And I see their loan to value since that disposal of Earl's Court is down in the low teens. So as
Yeah,
you say,
it's
very strong balance sheet.
correct.
And then just quickly on the local bonds, I see you holding a Nedbank and Standard Bank um, fairly short-term bonds. Um, any knock-on impact to the banking sector yields from what we're seeing in the government market?
Well, those are money market instruments, just an amalgamation of several banks' paper,
Mhm.
which is efficiently wrapped up by Nedgroup for us. But so we get a higher yield, but we have instant access to the money. So it's not an investment per se, but a place to get yield while we're waiting to find an investment. But in the corporate and the money markets in SA, with what's happening here and what the different rules and things that are happening, and yeah, obviously Edgar's blowing out. It's going to create all sorts of issues, and other companies are not going to be able to make it through the CV-19 crisis and the shutdown. There's going to be some pain in the corporate market. So we're looking at the corporates on the global context, but we're not looking at corporates in the SA context yet.
Okay, thank you. And just to finish off, Dave, give us some optimism. What's the prospects from here? What can we expect for the rest of the year? Obviously, being long-term holders, you don't move the positions of the portfolio around a lot, but as you've talked about already, you'll look to put money to work as and when appropriate. So just give us a kind of a what's your perspective view as much as you
Well,
can.
the future has always been difficult to forecast. It's particularly more difficult right now. But this too will pass. The impact on the SA economy, I think, will be a little bit more long-lasting. I think there's great buying opportunity in the bonds. If inflation goes down to 3%, which we think it will, to get a bond at 12%, to get 9% real, is a great opportunity. And from these levels, I think our expectation of 10% nominal from this fund, we expect to achieve that once we get through this crisis.
Okay, well, on that note then, Dave, I think we'll leave it there. Um, Thank you everybody for tuning in today. We've had a fantastic attendance, and Dave, thank you for being very open and with your views and the positioning on the fund. And again, thank you for the performance that you provided recently. I see the fund is now back at #1 over 10 years, and it's in the top decile of every cumulative period we look back through. So keep up the good work, and thank you very much.
Thank you, Rob. Thank you, Nedgroup, for the support, and thanks for the listeners for their support and all those people who have supported the fund. Thank you.
Have a fantastic day, everyone. Thanks very much.